Okay, so that's the question. That you have a new audit client, Miriam Makelo, who began a dental practice at MK Doctors Plaza in the year 2023. And the following transactions took place during the year ended 31st December 2023. Number one, Miriam opened a separate bank account for the practice and deposited 5 million as capital. In addition, she obtained a loan from the bank amounting to 5 million of an interest rate of 12% annually. The loan will be paid over 5 years period at 1 million annually, together with the interest due at the end of each year. Number two, Miriam imported 3 dental equipments at a price of 600,000 each and incurred a freight, insurance, and port clearance cost of 200,000 shillings each. The equipment is depreciated over 5 years. Number three, Miriam also bought other equipments for 1 million, furniture and fixtures for 2 million, and dental books worth 500,000. Both the equipment and furniture were to be depreciated over 8 years, while the dental books have a useful life of 5 years for the purpose of amortization. Number four, Miriam hired a dental assistant who also doubled as the clinic administrator at 60,000 monthly salary. A receptionist carrying out other clerical duties at 30,000 shillings per month, and a cleaner store casual at 15,000 per month. They all began employment on 1st January 2023. Number five, Miriam also hired the services of 2 other dentists to serve the increased number of patients, or when she was visiting another hospital for consultation. During the year, the 2 dentists were paid for professional services at 2 million. In addition, Miriam offered some intense learning opportunities and paid them a total of 300,000, a stipend over 300,000. Number six, during the year, our patients paid 6 million in cash, while those on various insurance and medical covers were treated at a total of 4 million. By the end of the year, the corporates and insurance companies had paid 2.8 million directly into the business bank account. Miriam also noted that a client owing 200,000 became bankrupt and would likely not pay, where the balance had nearly zero probability of default. Number seven, the cash that was received was banked, but after paying for the following items: we have got surgical and prescription medicine, 500,000. We have got stationaries, 40,000. Cleaning consumables worth 20,000. Cash drawings for personal use by Miriam averaged to 40,000 per month. By the end of the year, only 120,000 was available in the office safe. Number eight, a majority of transactions took place in the bank except for the one highlighted in note 7. Miriam placed some amount in a fixed deposit account and earned interest of 120,000. Other expenses were mainly salaries to staff, interest on loan, rent of 100,000 per month, electricity and water worth 60,000 for 11 months to 30th November 2023. She also paid 30,000 as subscriptions to the dental association. Note that Miriam had paid 3 months deposit on rent, which was refundable upon the termination of the lease. Miriam also drew 60,000 over month every month for personal expenses from the bank. Meanwhile, the electricity and water bills for December 2023 had not been paid, but were subsequently received and settled in January 2024 at 4,500. Number 9, that Miriam bought surgical and prescription medicine worth 1.5 million on credit. By the end of the year, she had already paid 800,000 of the amount, owing, while surgical and prescription medicine worth 400,000 was available by end of the year. Required, prepare statement of profit or loss for the year ended 30th June 2024, and also statement of financial position as at 30th June 2024. So in this question, what I want us to do is I want us to prepare a trial balance, a draft trial balance. We will have a column for adjustment. Then we can have a column now for the final trial balance. And lastly, we come up with what? Lastly, we come up with the statement of the income statement, as well as the statement of financial position, as well as the statement of financial position. So I want us to start right away. I want us to start right away. And I want us, let me separate my equation and workings as such. So here we're talking about AMK doctors. We're preparing what we call an audit schedule. AMK doctors plus so here we'll have our draft trial balance, and this draft trial balance will have a debit and credit. It will have a debit and credit. Okay, this draft trial balance will have a debit and credit. Are we together? Then you can draw the borders. I'm picking the thick outside borders. Then I'll assume that it will come up to around this point, up around this point. So I'll include this thick outside border to go up to this point. Do that and let me know if you've done, if you've managed to do that. Have you managed to do that, members? Are we there? Good. So we can start. So I'll just copy this, select this, copy it, then I move it to the next, I go to the next one, I paste it there, then I want them to be 5. Again to the next, I paste there, instead of repeating, then paste there, then paste there. So the first one is the draft TB, the second one will be adjustment. Adjustments. The third one will be final trial balance. The third one will be P&L. And this other one will be statement of financial position. Do that and let me know. Do that and let me know. Do that and let me know if that is what you've done. Yes, are we there? Okay, fine. So we can proceed. So here, I want you to come down here, upper. Here we want to get the total. So just set the formula equals to, then add this from up, column wise, mpaka hapo. Then you can drag these up to the end that way. You can drag it up to that point. Are we together? Once you get that, you let me know. Can we now proceed? Great. So we come here again. So we want to start from number 1. So Miriam opened a separate bank account for practice and deposited 5 million as capital. So here we'll start with the capital. So capital we always credit. Capital worth how much? 5 million. Capital worth 5 million. And for every credit entry, there must be a corresponding debit entry. Sawa. So here, if Ali letter capital worth 5 million, so automatically it was received through the bank, right? So we do what? What do we do with the bank? we debit bank. The bank has received 5 million. The bank has received 5 million. So, are we together there? We continue reading. So they're telling us here that in addition, she obtained a loan from the bank amounting to 5 million and an interest rate of this. So if I obtain a loan from the bank, then it means that hii pesa I receive through the bank. So the bank, we debit bank equals to hapa tunaweka plus 5 million. Amechukua loan ya 5 million, but now we credit the bank loan liability with the 5 million. Are we together? That way. Is that okay? Then we are being told that the loan will be paid over a 5-year period at 1 million annually. So when this year ends, this person atalipa 1 million. So what do we do? Akilipa 1 million, inamaanisha bank loan ina reduce. To reduce the liability, we do what? We debit. So analipa 1 million. But this 1 million is being paid from the bank. So if we remove money from the bank, we do what? We credit. So you credit the bank with 1 million. This one you put it under adjustment, because now it is adjusting our balances. That okay? Is that okay together? Such that mwaka ikiisha huyu mtu anajua kwamba ako na bank loan ya pesa ngapi? Ya 4 million, because alikopa 5 million but amelipa 1 million. Sawa sawa? Another thing, wametuambia together with interest due at the end of the year. So we talk about interest. So we have got interest expense. So the interest expense that will be paid in this particular year, what you have to remember is that when we talk about debit, then we talk about credit. We debit assets, we debit expenses, we also debit drawings. But when we credit what? Liabilities, equities, we credit incomes. Sawa sawa? Are we together? This will be guiding us. This is what will be guiding us. So when we talk about interest as an expense, what are we going to do? We are going to debit. So what is the interest rate? It is equals to this loan, you multiply by 12%, so that we can get the interest. That is 600,000, but it is being paid from which account? Because for every debit entry, there must be a corresponding credit entry. So we pay from which account? We pay from which account, members? From the bank account. So you come up with a bank account, you credit another 600,000. So it's equals to add plus 600,000. And to ensure that you are right, and angalia question if your figures are balancing. They should be balancing. They should be balancing down here. Up to that point, we'll be done with the note number 1. Can we go now to note number 2? Whereby we are being told that Miriam imported 3 dental equipment at 600,000 and incurred a freight charge, a freight insurance and port clearance cost of 200,000. So here we'll start with we're talking about dental equipment. Dental equipment. So this dental equipment was bought during the year. So we bring it under adjustment. So it will be equal to, open bracket, 600,000 600,000. We multiply by 3 because there are 3. 600,000 multiplied by 3. Then you add the port clearance amount of 200. So plus 200. Are we together? Up to that point. Together? Because these equipment, there are 3. So each of them has a cost of 600,000. But this person incurred a freight cost of 200,000. Remember, the cost of a machine is equals to its transportation cost, its own cost, plus the installation cost. That is why we are adding the 200,000. So that is why we are adding the 200,000. Now, this machine is going to be paid from which account? From our bank. So we pay for it from our bank. So plus hapa kwa bank we credit 2 million plus 2 million. Sawa. Then we've been told that there is something they call depreciation. So we'll come here and talk about depreciation expense as well as accumulated depreciation. So the expense will be debited, but the accumulated one tutaipeleka kwa credit side because now that one will be seeking to reduce the value of our equipment. Sawa. So what do? It's depreciated over 5 years. So our depreciation will be equals to this dental machine, you divide by 5. Because we've been told it will depreciate over 5 years. So the same figure, we come and do it and credit it there. Are we together? That way. So this particular depreciation is for dental equipment. It is for dental equipment. It is for dental equipment. That depreciation is for dental equipment. Yeah. Are we together up to that point? Depreciation should rephrase your question, please. Can't get it well. Arbe, what are you asking? Arbe, your question, please, you can elaborate more. Depreciation should, you know, the cost of our dental equipment is the consolidated figure that helped us now to come up with to make this particular equipment operational. So it is the 2 million. That is what we term it as the cost of this particular machine. I've said that when we talk about the cost of an asset, we include the transportation cost as well as the installation cost. All of it is termed as the cost of that particular asset. So you add it to the original cost of that machine. Okay, so that is it. We go to the next one. We go to the next one. That is number 3. Miriam also bought other equipments for 1 million, furniture and fixtures for 2 million, and dental books worth 500,000. So let's start. This person alinunua, but both equipment and furniture were to be depreciated over 8 years, while the dental books have a useful life of 5 years for the purpose of amortization. So let's start with the bought equipment for 1 million. So let's start with the equipment. There is an equipment that was bought for 1 million. So equipment at 1 million. So we can put it under credits and adjustments. So it's 1 million. But we do what? We credit the bank. Enda pale kwa bank, credit side, add 1 million. That way. Then this equipment is gonna depreciation. So wamesema ita depreciate over 8 years. So we'll have depreciation as an expense. Then we'll have accumulated depreciation. So tell me what's the depreciation? Tell me the depreciation. What is the depreciation? What is the depreciation? Yes, someone? What is the depreciation in this case? Katam, what's the problem with the 200? What is the problem with the 200? Yes? All right, let's proceed. So depreciation expense here, it is equal to what? This expense is equal to, we take this equipment figure, we divide by its useful life. It is 8 years, so that we can get our depreciation. So divide by 8 years, we get 125. So the same figure we do what? We credit under accumulated depreciation. So we credit it under accumulated depreciation. We credit under accumulated depreciation. So we go to the next one, is furniture and fixtures. RB, what's the cost of furniture and fixtures? What is the cost of furniture and fixtures? Yes? Great. So you debit the furniture and fixtures account with the 2 million. Then you credit bank account. So you come here under bank account, we add 2 million. We go to the next one. We go to the next one. And the next one here, we are talking about what? We are talking about depreciation. So we have depreciation expense and its accumulated depreciation. So someone tell me what's the depreciation amount for furniture and fixtures? What is it? They have said both equipment and and furniture to be depreciated over 8 years. So what's the depreciation? It's 250. So we just come and do what? Say equals to this figure, we divide by 8. This figure, we divide it by 8. Get to 50. So the same figure we credit under accumulated depreciation. Sawa. That is it. We move, right? We move to the next one. The next one here, we are talking about now dental books. Dental books. Dental books had a cost of how much? 500,000. So we write 500,000. For this 500,000, we must credit under bank because it's being paid by a bank. So plus 500,000. So we proceed to calculate its depreciation expense as well as accumulated depreciation. Can someone tell me the depreciation for dental books? I mean, it's amortization because it's talking about amortization. Just the same as depreciation. What is it? The meeting will be ending in 1 minute. So the moment it ends, you rejoin using the same link. The meeting will end in 1 minute. The moment it ends, you rejoin using the same link. So here it's equal to this one, you divide by 5. The same here, that is it. So when we come back, we'll be looking at the next additional information, that is number 4. You rejoin immediately using the same link. I hope we are together up to that point.